What's up, guys? Another Trade Genius podcast here. Bob and Phil, as always. Guys, if you haven't been paying attention to what's going on around us and you think we're in a new bull market, you're going to be in for a surprise. We've been warning you guys. We're going to go over a very interesting chart that I think will show you exactly how crazy things are getting right now and what the risk is to the downside. Let's get into it.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. So Bob, we're kind of in la la land, right? Last couple, 3 weeks, new bull market, looks like it's afoot, just, off to the races, Bitcoin's mooning, all is good, right?
Phil, you know what they say? You go to France in the summertime because you get to see the Eiffel Tower. And the traders this year are going to see the Eiffel Tower of stocks. So if you start looking at what's happening here with a lot of these stocks, that first half of that rollover has begun. And we'll show you some more charts next week. But, all the big high flyers all have that, basically the kiss of death move where they peaked, called a Sornet move up higher, where everything just jams up and then it's given all that back. And I can't tell you how many stocks now are painting a head and shoulders pattern with the right shoulder now being formed. So look, you and I have nothing to be rueful about because we're right. And these moves, it took this market 2 months to get where it is. And by the end of next month, it's going to be back to where it is today. So I'm back to where it was at the beginning of May. That's how these markets move. And that's why we're so concerned, Phil. And show you a chart here too. Europe's in a big mess. It's over for Europe now. They're in recession. Yep. And if you look at their PMI chart, if you haven't already thrown that chart up for me, is that the United States market and the European PMI or surprise indexes, they follow each other, Phil. And this is what happens here. Look at it. Europe's already down to minus 90, and the U.S. is still dicking around at just over zero. But that's not going to last. You're going to see that thing come down pretty hard, and they don't separate from each other. U.S. markets and European markets are usually pretty tied together. The U.S. seems to be a little spiffier sometimes, but in this case, the Europeans are going to lead us down.
Yeah, you'd be hard-pressed to find a larger divergence, I would call it. And if you look at when Europe does turn down sharply before the U.S. does it, the U.S. ends up catching down. So I think that, it's just, we know what's cooking under the hood. We've shown these guys how many charts and data points, everything from leading economic indicators to corrugated cardboard demand, it's all slowing down tremendously. I think the divergence here is one of the biggest ones we've ever seen, and I think that's what you have to be prepared for to the downside.
Yeah, look, let's be clear here, people. The data we're pulling off is economic data that the government doesn't give us. The government data has all kind of hedges in it. They try to basically mope you. They want to manage your perception, right? So that you make dumb mistakes that they get to take advantage of later. But everything else is just screaming. The alarm bells are screaming at us. This is a big problem. And I think this next chart we want to show people, this is our Bible. Okay, the secular Bible of trading is our liquidity system. And Phil, this is your baby, so I want you to go ahead and unveil the risk off signal for people.
Yeah. So, we told you guys we'd show you this chart, and, we're not going to do this every single time. If you guys want this template package, head over to the website and get it. For the cost, it's really invaluable to know. But we figured since, we've been warning you guys and, it's been, risk on essentially since mid-May. And so we basically try to trade with these signals. So we warn you about the big stuff, right? The bigger rotations. But in between the bigger rotations, we do have these smaller rotations, right? And we've been risk on since the middle of May. Well, we just printed a risk off officially today. And you can see too, if we zoom in on this chart, you're seeing a large drop, and that's why it triggered. And a lot of times in this market, when we've had these large drops, we end up getting a move lower, over the next couple, 3 weeks as things, and everything, breadth and everything has been in the upper end of the rotation. I mean, if you look at this measurement of breadth here in the stock market, we haven't had a rotation down to the buy zone in a couple of months. It's just been grind, 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 grind. So, but the longer you do that, usually the swifter the move back to the buy zone is. So our position would be that we stay short at least for the first leg of this move down into this zone. I think we're going to see a case where we may have a couple of, bounce, and then we push back down into it again until we get to some more, like really oversold levels, and then we'll get, a pity bounce. But you guys have to be prepared that the rest of this year, and that's what we've been harping on, is going to be a challenge. So for right now, this, usually when we get these risk off signals, that's not where you want to be swinging long, because even if they're mistimed by a couple of days, you're going to get larger rotations off this. This one down here at the lows was around the turn of the year, and we had this weird V shape in liquidity, and that was end of year adjustment. So there's a little bit of a false alarm, but ultimately they poured liquidity back in, and so that risk on signal fired. So we watch those signals around the beginning of the year because you do get that weird wiggle in liquidity readings. But other than that, this thing is, when you get the risk off signal, it's not like you don't ignore it. Okay, a lot of times you're gonna get very sharp moves afterwards. So that's what we've been trading off of. We've been swing trading off of the risk on, risk off signals, all driven by this liquidity. And the other thing too is over here, the fair value is just astronomically high. Okay, I've never seen a reading this high on fair value. And that kind of goes hand in hand with a lot of other readings that we've had, Bob, where we've gotten just super, super crazy readings on a lot of metrics in this market, positioning and etc. But I mean, we were over 500 points over fair value. And normally, we'll get maybe 200 to 300 points over fair value, and then we'll get a pullback. And this thing's just been building and building and building. And really what's driving it is liquidity, because you see the liquidity driving from first half of the year. Yellen was draining her account, but now Yellen's building her account. That's part of the liquidity drain with all the debt issuance. And now we've got this start of the sharp drop. And that's how all these moves begin. Sharp drop over here, sharp drop over here. You got to be very careful that if we're at the foot of a bigger rotation, then we're going to take out last year's lows, which I still think is the downside destination here, Bobby.
Yeah, and look, Jerome Powell's not done. So, what we've effectively done here in this economy is we've embedded 5% inflation just because of the increase of the money supply. And unless the banks actually go into a credit contraction or the Fed go into a credit contraction, then Yellen's spending is embedding 5% inflation, and he's just going to keep driving that number up. And Phil, I forget, you remember this, I always forget it, is he's looking for the Fed's fund rate to cross below the employment rate. I always forget there's a number that Powell's looking for, and we haven't hit it yet.
Yeah, Bob, let's jump into that chart because it's easier to see the chart here. So this is the unemployment rate in yellow. And what they want that unemployment rate, which is currently sitting at 3.7%. They want that higher than the core PCE, which is currently sitting at 4.7%. So if you're waiting or looking for the Federal Reserve to get dovish, however you want to say that, then it's going to be when yellow is going above red. All right. That's until then, they're going to maintain what they've been doing all year, all of last year, how it's hawk, and the market goes, yeah. And then now you're seeing the market backpedaling on their Fed fund rate expectations, right? Because remember, Bob, at the beginning of the year, they had cuts. I think they had up to 2 cuts by December. And you and I were going like, wait, what? Right? And then now they're finally believing Jerome Powell, and they've reversed course. Now they're basically guaranteeing, the Fed fund futures is guaranteeing a hike in July, and then no cuts for the rest of the year, which is finally they capitulated. So I think the market, if you're pricing in this market based on Fed funds futures, then I could see why you could make the case for going up the way it did. But now they basically, in one day after his testimony at Congress, Bob, basically reversed that. And so that's why I think, on top of everything else, the fundamentals and liquidity, you also have those rate expectations now have to be repriced in, and that in and of itself would bring the market down some.
Yeah, and look, and dependent on what he decides to do, is he mentioned that he may want to raise the capitalization at the banks by 20% higher, Phil. So that means he's going to force less lending that way.
Right.
It's another liquidity drain to force more money into the bond market to fund the government, and it's ultimately that's the plan, is at the end of the day, they need to save the dollar, and to save the dollar, they need to make sure the bond market has enough liquidity in it, and the stock market is secondary to that effort. And so, the easy part of what they've done is done. Now the hard part comes in, because she has to, remember, she's spending this money at the same time. She's just not building up a war chest. And so, and they deferred things while they were in that game they had with Congress. So it's going to be a tough slog going into the second half of the year. Also, remember, Phil, the VIX seasonality, we talked about this 2 weeks ago, from June 15th into July 30th is the 15th. Yeah, the 15th, because last Wednesday is risk off. It's VIX up 20%.
Yep.
And so all you need to do is have a backwardation, which means that the contract that's expiring next is higher than the contract expiring out into the following months. Right. And that causes then a lift in the risk off signals that that these risk managers have to obey, and they cut back on the spending. Right. So for our view, look at this chart, Phil, and I think this is clear to everybody else. And look, I had an awesome week, and I was hardly even here because I was been building over this last couple weeks for a July expiration on SPY puts and Q puts and some of these high flyers like SMCI. And I went on vacation, and basically I still haven't touched any of them, and they're starting to pay now because of the belief and trust we have in the system. And for you guys, that we throw this stuff out for you, is that when you get a risk off signal, you should be buying slightly out of the money puts 4 weeks out, and then sit on your hands until you get a reversal signal. And that's not necessarily a risk on signal, but like Phil showed you get an oversold reading, then you go ahead and you close them off. But you'll make a lot of money, with this liquidity system by you buy when it says risk on, and you short when you have risk off. And you should check it out, guys. The thing is dirt cheap compared to what you get out of it. We're told to charge much more for this. We won't. And it's a great system. And just go in there and check out the store, tradelikeagenius.com. You'll love it. And if you have any questions, just call us or hit chat. Matt will be happy to help you with it. And like I said, check it out. And we have a lot of other cool toolkits that you can buy. But this one, by far, this one will pay for itself. If you took the trade just this morning, you've already paid for a year of it. If you just bought 10 put contracts. Okay, that's how much value you get out of this compared to what it does for you. So with that, Phil, I'm off my soapbox. Friday down, Monday down. We have a really, really important video for you guys tomorrow, because, when it rains, it pours, okay, in terms of bad news. And I think we're going to get something coming out of left field that people thought was not going to be an issue, but it's coming, and it's coming on hard. So stay tuned for that tomorrow.
All right, guys, thanks for watching. Please hit like and subscribe, and we'll see you on tomorrow's video. Take care.
Trade Genius.